Hello, I'm Juliette Sarli. In this week's edition of IG Macro Intelligence, we take a look at Australia's booming data centre market and ASX stocks to watch. Australia's data centre sector is surging, fueled by rapid cloud uptake, AI growth and rising digital sovereignty needs. NextDC is building a $7 billion 650 megawatt data centre in Sydney's Eastern Creek, set to become the biggest in the Southern Hemisphere, and has secured ChatGPT owner OpenAI as its major customer. The deal marks a significant step in Australia's bid to establish itself as a regional hub for fast-growing global data centre investment. Treasurer Jim Chalmers has hailed the deal as significant for Australia, saying it will provide thousands of direct and indirect jobs. Brokers are similarly upbeat on NextDC's stock, with Morgan Stanley recently upgrading its price target to $21 with an overweight position, suggesting the stock can rally close to 50% from current levels. The average broker target is a buy, according to Refinitiv data, with a mean target price of $20.95, suggesting 48% upside. However, shares have underperformed over the past 12 months, and ASX TradeWatch data show the trend appears to be weak, with little demand from investors for the stock.
These shares have been under pressure as the question marks on the AI trade have been raised over the last 6 weeks or so. I think, we're likely to see a floor in the share price now. These two announcements from NextDC through the course of the week. They don't need to raise capital to deploy these new data centres, at least for the next 2 years on our numbers. And with a return to momentum coming through in terms of contracted billing, new customer inquiry, I think that, seeing it today, but I think this does really put a spark underneath the share price.
However, not all analysts are as optimistic.
It's like the ultimate field of dreams, isn't it? Build it and they'll come. It's like Kevin Costner's at the helm, swinging the bat. Or was he a pitcher? I've never seen the film, but I know the concept, and I see it all too often in this game, where people just build stuff and people buy it. And people, we're going to talk about some stocks today where they've literally raised $100 million. I don't know how it's going to pay itself off.
In general, the actual data centers themselves, I've put them in the too hard basket. I see a lot of investors, and I think quite rightly, point to these big capex booms we've had in the past, be it, take it back decades ago with railways and things like that, but even the telecom boom back around the 2000s. And inevitably what happens is these companies will overbuild, predicting these huge uptakes, and then just the economics just don't quite come in behind it.
And Merewether Capital's Luke Winchester prefers Macquarie Technology Group, which operates 3 data centre campuses, 2 in Sydney and 1 in Canberra.
There's also some nice IT managed services. I know the old telco business is sort of in decline. There's good cash flow coming out of that. I think you've got a defensive earnings stream from the other parts of the business, and then the upside of the data centres as well.
Well, shares have fallen close to 30% year to date, and technical data also show they're in a near downtrend, specifically confirmed by a drop in the 20-day moving average, suggesting investors see better opportunities elsewhere. Meanwhile, Goodman Group shares have fallen around 22% over the past 12 months and appear to be in a long-term bearish trend, confirmed by multiple indicators. Brokers, though, upbeat on the stock with an average target price around $38, suggesting 28% upside.
We're bullish on the whole sector. I think it's the demand for these data centers is only going to go one way, but it's going to become more and more complicated, as obviously we've seen news about how much power they need, how much water they need. So I think there's going to be a little bit of pushback about new developments, and it's probably going to become quite expensive. So we do like Goodman in the sense that they already have a lot of assets that are up and running and ready to rock.
And finally, Digico Infrastructure REIT, a diversified owner, operator and developer of data centres with a global portfolio. Well, when you look at technical data, sentiment is down for this stock. It's down around 45% over the past 12 months, but sentiment could be improving. The demand-supply balance for the stock is stabilising, suggesting either a pause in its current downtrend or the possibility of an uptrend. The average broker recommendation is a buy, according to Refinitiv, with a $3.90 price target, suggesting 56% upside. And that is your IG Macro Intelligence for this week. We'll see you next time. Bye.